What caused investors to put on more than 50,000 long gold contracts in the past few days? Once you understand and have the right question, the answer is obvious. Good morning, it's Jeffrey Christian of CPM Group. It's about 10:15 on the morning of Friday, the 3rd of November here in New York. Gold's trading a little over $2,000. It's trying to break above $2,000 on a more sustained basis, as it has been trying in recent weeks. Silver's around $23-40. We had a actually relatively healthy jobs report this morning. The rate of 140 some odd thousand new jobs being created last month is actually in the zone that economists find as strong and sustainable. It's down from recent levels, but it suggests a strong economy, which other data has shown too. I'll talk a little bit more about the market outlook later, but I wanted to continue the discussion that we've had in a couple recent videos. A couple recent videos have discussed one problem that some investors have, in that they're constantly looking to find information that confirms their beliefs in conspiracies and market manipulation. And in doing that, they look at the wrong data, they interpret data incorrectly, and they jump to conclusions. The problem is compounded for these investors because there are chronically wrong promoters who also misuse data. So you'll have people out there who have been talking about the collapse of the inevitable, almost immediate collapse of the Treasury market since 1981. You have other people who have been talking about conspiracies and manipulation in the silver and gold markets since the late 80s and the late 90s. They've been wrong, and they misuse data, and they provide the confirmation for those people who want to find conspiracies and market manipulation. So we talked about this in the October 27th video. We talked a little bit about it earlier this week. And the thing that I said and wrote was that if you look at the questions that people ask, they're asking the wrong questions. And that tells you more about their biases and their lack of understanding of the markets and financial markets than it does about whatever the question is. So 2 days ago, November 1st, we received this comment on our October 31st video. If there's no manipulation, why have swap dealers put on more than 50,000 short gold contracts in the past few days? Why would a bullion bank do that? Why would they hammer the gold price now? The question tells you the person is looking at the market backward. What the proper question is, what caused investors to put on more than 50,000 long gold contracts in the past few days? See, brokers and traders, commercials, basically are responding to their clients. And their clients are industrial companies that produce or use commodities, and investors, mostly investors in the futures and options market. Brokers and traders don't necessarily go around putting on long or short positions on their own account in a naked way. What has happened, and I'll show you a chart here, is that the trades originate with the investors. And the proper question is, what caused investors to put on more than 50,000 long gold contracts in the past few days? Once you understand and have the right question, the answer is obvious. And here you can see the increase in open interest on gold contracts, and it's really actually been several weeks. You have to go back to, say, the middle of July, when you could see that you had about 42 million ounces or 43 million ounces of total open interest, and it has risen to about 48 or 49. So you have seen open interest rise. But again, you have to understand why that's rising. It's rising because investors bought 5 million ounces of gold futures and options during that period of time. And if you can't answer that question yourself, why did investors buy 5 million ounces of silver futures and options over the last couple of weeks? You haven't been watching the news, or you've been watching the news on the wrong channel. I won't go through it all. I'll just talk about the Hamas attack on Israel and the Israeli counterattack on Gaza. I'll talk about strong economic conditions. I'll talk about ongoing political problems, the ongoing war in Ukraine, which has been overlooked by the Middle Eastern crisis. You saw oil prices rise, and then they came back down. You have seen relatively strong still inflation. It's coming down, but it is still strong. There are any number of factors that cause investors to buy 5 million ounces of gold futures and options over the last few weeks. And the brokers and dealers, when an investor buys a futures contract, a commercial has to go short that contract. That contract doesn't exist until the investor says, I want to be long gold. And then a commercial entity has to step up and say, in my role as a market maker, I will sell you that gold contract. They're the passive agents. If you want to know what's going on in the gold market or the silver market or any other commodity market or any other financial market, you have to focus on the investors. That's where the decisions are made. So the question to our friend is not why they would, these bullion banks go short 50,000 contracts. To answer that question is very easy. They went short 50,000 short gold contracts because their clients, the investors, went long 50,000 gold contracts. If you ask the right question, and if you understand the markets, there ain't no manipulation, there ain't no conspiracy. So where are we right now? We had an FOMC meeting. What the Fed said afterwards is a reiteration of what they've said all along. They didn't raise interest rates. They're looking at inflation coming down, actually faster than they thought it would, but still, PCE is at 3%, CPI is around 4%, still higher than they want. Very strong economy, so much for the increase from 0 to 5.25 Fed funds rate driving the economy into a recession. They're still looking at a strong economy. The UAW strike is over now, so that will add an additional oomph to the economy. We do have a dysfunctional government, and they are now 2 weeks away from their deadline for what will ultimately be another continuing resolution. I think markets are a little bit inoculated from the stupidity of Congress right now, in that they watched a lot of economic value being lost in September and October due to the melodrama in Washington. And they realized that at the end of the day, it's politicians playing with us all. And they understand that, we might have a government closure for a while, but the economy transcends the government activity. So you're looking at an economy and you're looking at financial markets that look at the economy and say, okay, it's pretty good, steady as she goes. Now, it's funny because CPM Group, we're often staying still and we shift where we are relative to the rest of the market. So if you go back 8 months or 10 months or 12 months, we were saying we looked at 2023 as a year where we would see relatively decent economic growth. It's actually been stronger than we expected. We didn't expect a recession. We didn't expect the bond market to crash the economy. And we thought that precious metals prices would rise modestly. they've actually risen a little bit stronger than we thought probably 12 months ago. You have gold on an annual average basis that's at a record level. It was a record $1,804 last year. It's probably going to be a record around $1,940 some odd dollars this year when the year's over. It's a pretty good increase in gold prices. Silver prices have risen. They're not near their record levels, but they are relatively strong by historic standards at around $23, $24 an ounce. We had this view, and the market consensus was, no, the Fed is going to crash the economy. We're going into a recession. The Fed will have to lower interest rates. We said, no, we don't believe that. To fast forward to November 3rd, 2023, and we're pretty much saying the same thing that we were saying then. Yeah, we didn't think 23 would be a recession, but we're watching 2024, 2025. There are a lot of economic and financial problems. There are political problems. It's going to be an election year. Congress and the administration will do a lot of stupid things. And we may well see a recession in 2024, 2025. Meanwhile, the market consensus has gone from, imminent recession in 2022, 2023 to maybe we won't ever have another recession. They were wrong then. They're wrong now. We will have recessions in the future. Recessions are part of the financial and economic reality of the world. We will have them. Whether it's in 2024 or 2025 is uncertain, because what causes recessions varies from recession to recession and varies over time. But there are those economic and financial issues as well as political issues hanging over the economy. We haven't moved in our position. We've adjusted our position, but we've gone from being bullish on the economy relative to the consensus to now being bearish on the economy relative to the recession. So basically, we're where we are, and we're staying where we are because we look at the markets and we look at the data and we look at supply and demand and we look at economic activity. We don't necessarily pay attention to the consensus views. Gold has been trading in this range. It's at the high end of the range. It's testing 2,000. We have said that we thought that the gold price would probably average above 2,000 next year and possibly average above 2,100 in 2025. We're still holding that view. We think that the cyclical weakness that we had expected in August, September, October is behind the market now, and that the price will shift higher. Similarly with silver, we expect higher prices in 2024 and 2025. We think that that cyclical decline that's so obvious on these two charts is now probably behind the market. That doesn't mean that prices won't come off. That doesn't mean that gold can't fall back to 1950 or even 1900, and silver can't fall back to 2250 or even $22. But it means that they probably won't stay there the same way they didn't stay there a month ago in late September. And we think that when the price looks like it's likely to rise, investors will probably come in and buy futures and options in increased volumes. And that will show up in long open interest in the commitment of traders for investors. And it will show up in shorts, offsetting shorts, by the commercial entities that sell those futures and options to those investors. And it won't be that the commercials are trying to whack or hammer the price down. It's that they're supplying a product that their customers are ordering. If you don't understand that, there's probably a community college near you that probably has some interesting evening courses. Platinum and Palladium, they're suffering from structural changes and tactical changes within the auto industry, and their prices are vulnerable. They're vulnerable on the short term, and they're vulnerable on the long term. We have just finished our annual review of our Platinum Group metals, platinum, palladium, and rhodium long-term outlook. We take our supply, demand, and price projections out to 2050, because we think it not just the normal 10 years of projections, but out to 2050, which is now 27 years, because we think that the structural change in the energy transition will be much slower and much more erratic than a lot of other projections would have it, and that the shift in the energy mix, both in terms of supply and demand, and automotive markets, and the effects on platinum, palladium, and rhodium, are going to be much more a long-term development than a shorter-term development. And we're starting to see the consensus, which has been on the bullish side for electric vehicles compared to us, shift back toward where we are. And we wouldn't be surprised to see that consensus shift to the other side. But we'll probably be standing pretty much where we have been for the last 5 years or so. That's all I have for now. Take care of yourself. Have a good weekend. Take care of those around you and try to do something good for the world. And we'll talk to you next week.